Welcome, investors and financial enthusiasts, to another enlightening chapter in our exploration of the 10 golden principles of investing, each one carefully honed through the wisdom of Warren Buffett. Today, we venture into the heart of Chapter 9, Avoid Debt. Debt, as I've often emphasized, is a double-edged sword in the world of investing. It can either be a valuable tool when wielded wisely or a perilous trap when mishandled. The key to mastering this principle lies in comprehending how to navigate debt effectively, for it is fundamental to securing your long-term financial success. Debt, much like the currents of a river, can either propel you forward or pull you under depending on your skill in maneuvering its waters. This chapter sheds light on the significance of not only understanding the nuances of debt but also mastering the art of avoiding its snares. It is a vital piece of the puzzle in the journey towards sound and prosperous investment decisions. Throughout my life, I've adhered to principles that prioritize financial prudence and security. These principles are not merely theoretical. They are the very cornerstones on which my wealth and success have been built. As we traverse this chapter on avoiding debt, you'll gain insights into the very same strategies and philosophies that have guided my own investment journey. So fasten your seatbelts as we embark on this voyage into the world of debt, where we'll uncover its risks, rewards, and how to navigate its treacherous waters. Join us in this exploration of Chapter 9, and remember to hit the likes button to show your support and subscribe to our channel to continue unraveling the wisdom within the golden principles. Debt can be a corrosive factor for financial stability. It's like a double-edged sword that, if wielded recklessly, can severely impact one's investment prospects. Understanding the perils of debt is essential. In this scene, we'll explore its pitfalls and the risks it poses to financial health. Debt, like a shadow that looms over one's financial well-being, carries certain perils that every prudent investor should be aware of. The most apparent danger lies in the interest payments, which can become a relentless drain on your resources if not managed wisely. High-interest debt can erode your returns and slow down your journey toward financial goals. Furthermore, debt can amplify the volatility of your investments. Leverage or investing with borrowed money can magnify your gains, but it also magnifies your losses. During market downturns, leveraged investors often find themselves in a precarious situation, forced to sell assets at unfavorable prices to meet debt obligations. Another peril of debt is that it narrows your financial flexibility. When your income is tied up in servicing debt, it limits your ability to seize new investment opportunities or weather financial emergencies. In this scene, we'll dive deep into these risks and illustrate the potential consequences of mismanaging debt. It's not about painting debt as an evil force, but rather it's about understanding its potential pitfalls and learning how to wield it as a financial tool judiciously. How does debt influence your investment decisions? We'll examine the direct relationship between incurring debt and making investment choices. It's about understanding how being leveraged can impact the quality of your investment decisions and ultimately your financial well-being. Debt isn't a mere financial figure on a balance sheet. It's a decision-making factor that can sway your investment choices. When you have debt obligations, your investment decisions are often influenced by the need to meet those obligations. It can lead to a short-term focus on generating cash rather than making the best long-term investments. Leverage, while it can amplify gains, also magnifies the consequences of poor investment decisions. In this scene, we'll explore how debt can lead to rushed or riskier investment choices, as investors feel pressured to generate returns quickly to service their debt. Additionally, we'll uncover the connection between debt and the risk tolerance of investors. Having high levels of debt can make investors more risk-averse, fearing the consequences of investment losses on top of existing financial obligations. This risk aversion can limit the potential for higher returns. Understanding the relationship between debt and investment decisions is essential. It's about recognizing that debt is not just a financial number, but a factor that can influence your entire investment strategy. By the end of this scene, you'll have a better grasp of how to navigate this complex interplay between debt and investment choices. Debt holds a remarkable power to shape and often impede cash flow, a fundamental aspect of both personal and business finances. This scene aims to illuminate how borrowing, with its financial burden, affects the ebb and flow of available cash. It's more than just numbers on a balance sheet. It's about the liquidity and resources available for both individuals and businesses. The understanding of how debt influences cash flow is pivotal for sustaining the stability necessary for long-term investments. We'll navigate the intricate ways debt impacts the ability to allocate resources, maneuver through economic seasons, and ultimately influence the trajectory of your financial journey. Debt transcends mere financial numbers. It has a profound psychological impact on individuals and their financial decisions. In this scene, we'll delve into the psychological implications of carrying debt, exploring the stress, anxiety, and limitations it imposes on one's ability to make financial decisions. Debt isn't merely a financial liability, it's a mental burden. The weight of debt can constrain one's future outlook, leading to cautious or restricted financial choices. Understanding the psychology behind debt is crucial for making astute investment decisions. It's about recognizing how debt can influence decision-making, instill fear, or curtail the ability to embrace opportunities that could lead to financial growth and stability. Unveiling this psychological facet of debt is vital in guiding investors towards sound and confident financial choices. Next, we delve into the actionable strategies and tactics that empower investors to navigate the financial landscape with minimal or no debt. These strategies are not just theoretical concepts, but practical steps to implement in your financial journey. By understanding and applying them, you're taking significant steps towards securing your financial future. One effective strategy is establishing an emergency fund. A well-funded emergency reserve can cushion you from the unexpected financial shocks that often lead to debt. We'll discuss how to build and maintain an emergency fund that can act as your financial safety net. Another crucial aspect is budgeting. We'll explore the art of budgeting and financial planning, which are essential for maintaining financial discipline. Understanding where your money goes, setting financial goals, and creating a budget that aligns with your objectives is a proactive step in avoiding unnecessary debt. Additionally, we'll touch upon smart financial choices, such as distinguishing between good and bad debt. Not all debt is created equal, and understanding the difference can be a key factor in making informed financial decisions. We'll provide insights into identifying when it's prudent to take on debt and when it's best to avoid it. This scene is all about arming you with practical tools and knowledge to make prudent financial decisions and, in doing so, steer clear of debt. By the end of this segment, you'll have a clear roadmap for avoiding debt's pitfalls and maintaining financial stability. We'll examine how a debt-free approach aligns with the broader goal of securing long-term financial stability. Debt can be like a chain that binds your financial future. It places limitations on your choices, impacts your financial security, and reduces your flexibility in making the most of investment opportunities. Through real-world examples and practical insights, we'll uncover how adopting a debt-averse mindset sets the stage for a secure financial future. By minimizing debt, you're essentially freeing up your resources to invest in assets that appreciate over time and generate sustainable wealth. This segment is a reminder that debt, while sometimes necessary, should be approached with caution and a clear understanding of its impact on your long-term financial stability. Avoiding debt isn't just a financial decision, it's a commitment to safeguarding your financial future. By the conclusion of Scene 6, you'll appreciate the profound implications of this choice and be better equipped to make debt-averse decisions that lead to lasting financial stability. These extensions provide a more detailed perspective on the strategies to avoid debt and the long-term implications of staying debt-free. It adds depth to the scenes, emphasizing the practicality and significance of these principles inspired by Warren Buffett's wisdom. When we speak of financial freedom, we're talking about the ability to make choices without being hampered by financial constraints. Debt can be a heavy anchor that holds you back. By steering clear of debt, you're freeing yourself from this burden. The choices you make become more deliberate, less encumbered by the weight of interest payments or the stress of debt servicing. Financial freedom is a multifaceted concept. It encompasses the freedom to pursue your dreams, whether it's early retirement, starting a business, or traveling the world. It's the freedom to make investments that align with your goals, not just those driven by the need to service debt. When you avoid debt, your financial choices are guided by your aspirations and values. Moreover, financial freedom involves having peace of mind. You're not constantly worrying about paying off loans, which allows you to focus on what truly matters. It's about being able to withstand financial shocks or unforeseen expenses without falling into a debt spiral. By avoiding debt, you create a financial cushion that brings tranquility. Debt-free living also translates into the ability to accumulate wealth over time. The money you might have spent on servicing debt can now be channeled into investments, savings, and assets. It's the power of compounding working in your favor, gradually building your net worth and securing your financial future. In essence, avoiding debt paves the way to crafting a life where your financial decisions are guided by your dreams, values, and aspirations. It's a journey towards economic independence, peace of mind, and the accumulation of wealth over time. In conclusion, steering clear of debt is not merely a financial choice, but a lifestyle decision with profound implications. It's a pivotal step in your quest for financial freedom and security. By understanding the implications of debt and making informed decisions about its use, you align your financial journey with the principles of long-term financial stability and the pursuit of freedom. Join us in our next chapters as we continue exploring the timeless wisdom of Warren Buffett's investment principles. If you found this information valuable, remember to like and subscribe to our channel for more insights on the path to financial success.